I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a multifamily housing REIT. Shelter, it's a basic need. Really can't live without it. Well, this company provides it. It owns thousands of apartment units, which it leases out to willing renters. And thanks to lots of red tape and geographic barriers, supply is tight. Tight supply on something with high demand, as you might imagine, that's leading to growing revenue and profit and bigger dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Essex Property Trust Inc., which appear to be trading at a significant discount today. Essex Property Trust Inc., stock ticker ESS, is a real estate investment trust that owns and operates a portfolio of U.S. West Coast multifamily properties. Founded in 1971, the company is now a $16 billion by market cap real estate giant that employs more than 1,700 people. Essex Property Trust focuses on 3 different supply-constrained markets. Southern California, 42% of NOI, Northern California, 40%, and Seattle, 18%. The company's property portfolio consists of approximately 62,000 apartment homes across 252 apartment communities. Commercial real estate is fraught with pitfalls, largely because most forms of it are rather discretionary. Office buildings, enclosed shopping malls, restaurant buildings, etc. However, Essex Property Trust separates itself from the REIT pack by focusing on shelter, a very non-discretionary basic need in life. The demand for shelter is built right in, and the runway for that demand extends out for as far as humans will need somewhere to live, that is forever. Shelter has effectively no risk of obsolescence. Technology is changing our world in all kinds of amazing ways, but it's hard to imagine it changing shelter. As such, I see multifamily housing as being far more investable for the long term in comparison to many other forms of commercial real estate. One thing that makes Essex Property Trust unique relative to its U.S. multifamily housing brethren is the company's property portfolio footprint. Essex Property Trust has concentrated itself along the U.S. West Coast. This could be both the company's greatest strength and greatest weakness. On one hand, a combination of unique geography and heavy-handed regulation across West Coast jurisdictions conspire to limit supply. The West Coast is filled with natural areas that are prohibitive to building much of anything, limiting the supply of usable land for construction and acting as a natural barrier to entry. Regulatory red tape only adds to supply constriction. Existing supply is that much more valuable when it's so difficult to bring new supply to market. These same supply issues plague single-family houses in these markets, which only serves to make apartments more affordable by comparison. All of that plays right into the hands of Essex Property Trust. On the demand side, the West Coast is highly desirable. It has an alluring mixture of high-paying jobs, temperate climates, and beautiful nature. California is, by far, the most populated state in the U.S. for good reasons. If California were its own country, it'd have the 5th highest GDP in the world. So it's both strong demand and limited supply working to the REIT's favor. On the other hand, a homelessness crisis, rising crime along the I-5 corridor, and an extremely high cost of living combine to mitigate demand for West Coast living. In addition, the work from home trend, which has demonstrated some staying power, makes it easier for remote workers to move to cheaper locations inland without losing their high-paying jobs. but fully remote jobs are still somewhat rare and you can't take the climate and ocean with you when you leave. In my view, many, but not all, of the problems facing the West Coast are fixable and most likely temporary in nature, at least to the degree at which they're currently present. However, the appeal of the West Coast is not temporary, nor is the need for shelter. Both are enduring, and that's exactly what positions Essex Property Trust to continue growing its revenue, profit, and dividend for many years to come. Essex Property Trust has already increased its dividend for 29 consecutive years. Two quick reasons why this is amazing. First, it dates all the way back to the company's original IPO, showing just how reliable and relentless Essex Property Trust has been since the very beginning. Second, it makes Essex Property Trust a vaunted dividend aristocrat, one of only 3 REITs in the world that can claim that status. The 10-year dividend growth rate of 7.2% is strong, as most REITs are slow growth income vehicles. On the flip side, the stock's 3.8% yield isn't as high as what you can find among many other competing options in the REIT space. However, I'd argue that the high consistent growth and long-term compounding prowess is worth the short-term yield trade-off. Moreover, this yield is well over what the broader market offers and 60 basis points higher than its own 5-year average. And with a payout ratio of 60.9% based on midpoint guidance for this year's funds from operations per share, Essex Property Trust has a healthy dividend. Most REITs that I track have payout ratios in the 70% or higher range, so this relatively low payout ratio is encouraging. A near 4% yield paired with a high single-digit dividend growth rate from a dividend aristocrat, I think that's pretty compelling. Looking at business growth, Essex Property Trust advanced its revenue from $611 million in fiscal year 2013 to $1.6 billion in fiscal year 2022. That's a compound annual growth rate of 11.3%. Excellent top-line growth. Unfortunately, it's slightly misleading. When it comes to REITs, it's imperative to look at profit growth on a per-share basis. That's because REITs use debt and equity to fund growth, as they're legally required to distribute at least 90% of their taxable earnings back to shareholders. This circles back around to the point I made earlier on REITs being primarily income plays. Limitations around internal funding for growth means tapping equity by issuing shares, resulting in dilution. That tends to create distortions between absolute revenue growth and profit growth relative to shares outstanding. Also, when assessing profit for a REIT, we want to use funds from operations instead of normal earnings. FFO, or adjusted FFO, is a measure of cash generated by a REIT which adds depreciation and amortization expenses back to earnings. Essex Property Trust grew its funds from operations per share from $7.59 to $13.70 over this 10-year period, which is a compound annual growth rate of 6.8%. This is a more realistic portrayal of the company's true growth profile. Not as amazing as top-line growth, but still very good. It's a high single-digit growth out of a basic need that has practically no risk of obsolescence. When you adjust for the risk, the growth profile is pretty appealing. We can also see how well dividend growth has tracked funds from operations per share growth over the last decade, showing deft stewardship from management. Looking forward, CFRA currently has no 3-year growth projection for the REIT's funds from operations per share. That's a shame. I generally like to compare the proven past up against a future forecast, which helps with extrapolating out results and narrowing a range of possible outcomes. Absent this information, I'll instead lean on recent guidance provided by Essex Property Trust itself. The company's most recently released guidance is calling for $15.10 to $15.22 in funds from operations per share for fiscal year 2023. At the midpoint of $15.16 per share, that would represent 10.7% year-over-year growth. And that's in a tough environment for comps. Keep in mind, this is coming on top of a multi-year bonanza for multifamily housing. For a variety of reasons, the pandemic resulted in a demand boom for suburban housing options. That played right into the hands of the likes of Essex Property Trust, since most of its inventory is in more suburban locations. It's mighty impressive to see Essex Property Trust maintaining above average growth off of an elevated profit base. All that said, Essex Property Trust doesn't need to produce extraordinary results in order to make shareholders plenty of money. If the company can simply maintain its ordinary historical level of growth, it'll do well. Indeed, this has been a winner of epic proportions since the IPO. Per the company's November 2023 shareholder presentation, Essex Property Trust has provided a 4,335% total return from its June 1994 IPO through October 2023. far ahead of the 1,509% provided by the S&P 500 over the same time frame. Also, I think it's time to clear up the misconception that people are fleeing the West Coast. That's simply not showing up in the numbers. The company's Q3 fiscal year 2023 earnings report showed same property portfolio occupancy at 96.4%, up from the 96% mark 1 year ago. Occupancy is up, not down. If there is any fleeing occurring, it's most certainly not happening at Essex Property Trust properties. Overall, I see nothing to indicate that Essex Property Trust cannot continue to deliver the high single-digit dividend growth that shareholders have come to expect. The business is doing well, and the payout ratio offers a large cushion. Moving over to the balance sheet, Essex Property Trust has a good financial position. The company finished last year with a bit under $6 billion in long-term debt, which isn't terribly high relative to the market cap. A common measure for a REIT's financial position is the debt-to-EBITDA ratio, which is 5.5 on an adjusted basis for Essex Property Trust. I usually see REITs range from 3 to 7 on this ratio, putting Essex Property Trust at somewhere in the middle. The weighted average interest rate on its debt stands at 3.4%, putting its cost of capital at a reasonable level. Moreover, the company has investment-grade credit ratings: BBB+ Fitch, Baa1 Moody's, and BBB+ Standard & Poor's. Overall, there's a lot to like about this REIT, not the least of which is the fact that its core offering is a basic need that just so happens to be located in one of the most in-demand areas of the entire world. And with economies of scale, regulatory know-how in difficult markets, natural barriers to entry, and an entrenched footprint in supply-constrained and desirable locations, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. California's infamous red tape is a double-edged sword. Constraints on bringing new inventory to market help to boost the value for existing properties, but it's also difficult to grow the portfolio. Real estate is generally cyclical, although the basic need of shelter does mitigate some of that cyclicality. Essex Property Trust has indirect exposure to the technology industry, as a lot of tech companies are based on the West Coast. The capital structure of a REIT relies on external funding, both debt and equity, for growth, and rising interest rates can create harm in two ways. Debt becomes more expensive when rates are higher, and competitive yields elsewhere reduces demand for equity. Essex Property Trust lacks geographic diversification. The West Coast exposure introduces risks of natural disasters such as earthquakes. As work becomes more flexible, more remote workers could choose to leave the West Coast for cheaper locations inland. While these risks should be weighed, the quality of the business should also be weighed. The valuation, which looks attractive, is also something that has to be weighed. The stock is trading hands for a forward price to funds from operations ratio of 15.9 based on midpoint guidance for this year's funds from operations per share. That's somewhat analogous to a PE ratio on a normal stock, not demanding at all. The price to cash flow ratio of 16.4 is also well off of its own 5-year average of 20, and the yield, as noted earlier, significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis that factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. This mark is below the company's demonstrated EPS and dividend growth over the last decade. With the payout ratio where it's at and with business growth as good as ever, I don't see why the foreseeable future will look much different than the recent past. After all, this is a type of commercial real estate that has built-in enduring demand, and the geographic footprint fortifies the firm's advantages. The dividend discount model analysis gives me a fair value of $281.16. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates ESS is a 4-star stock with a fair value estimate of $305. Safari rates ESS is a 3-star hold with a 12-month target price of $225. We have a fairly broad range here. Averaging the three numbers out gives us a final valuation of $270.39, which would indicate the stock is possibly 11% undervalued. Here's the bottom line, guys. Essex Property Trust Inc. is a great REIT that offers the basic enduring need of shelter to willing renters in some of the most desirable locations in the world. Because of regulatory hurdles and natural barriers to entry, its entrenched supply is a powerful advantage. With a market-beating yield, a moderate payout ratio, a high single-digit dividend growth rate, nearly 30 consecutive years of dividend increases, and the potential that shares are 11% undervalued, long-term dividend growth investors should take a close look at this Dividend Aristocrat. And now for a special news announcement. Wedbush securities analyst Dan Ives recently came out and predicted that Apple Inc., stock ticker AAPL, will be the first company to ever hit a $4 trillion market cap, and he believes it'll do so by the end of 2024. As I've said countless times now, Apple is a must-own stock for serious long-term dividend growth investors. If you think it's too late to get on the Apple train, think again. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.